let's wait for another 2 minutes, then we will just start on today's lesson. Seems like the connections to the other system is not working really well, but yeah, it's okay. We will start on today's session too. Then maybe on the apps we can just take a look at the recording afterwards. Yeah, I already checked that. It's not really showing properly. Well, yep, it's not showing up. It's never mind. We will start on today's sessions. So yeah, happy to see you guys again on this week. It's been a while since last week, and then I hope you guys are making money. Today's KL weather is really freaking cold. Yeah, so today we will talk about the vertical spread. In this week, we will talk about the bull vertical spread, and in next week, we will talk about the bear vertical spread, which referring to the upward movement and also the downward movement. So today we will be focusing on the bull vertical spread. So it might be helpful to catch all those bullish move in the market when comparing to just using a very simple single leg options. Today this is like a combination between buying an options and selling an options. So there's pros and cons come together, and then this is also the most common practice in the market, and we already show it up in the previous class, but today we will go into detail of how it works and then the theory of it. And then starting from this week, we will just move into the advanced option classes, and then on every week, every Wednesday, we will talk about the advanced strategy to be used on the options market. And then if you did join for our pro member in uSMART, or you did join our WeCom group, we also will share all those like market strategy for options, the daily option strategy in the group. And then mostly we will be using the combinations of this kind of vertical spread. So if you are not very familiar and you want to follow our strategy, you want to follow our suggestions, today's classes will be a very good practice for you to just step into what is a vertical spread. So you can have a better understanding on what is the vertical spread and how do you just to put it into use by after understand all those basic and theory, and then you can just referring to our suggestions on the group daily, and also we also post that in the apps, but you need to be a pro member to access to all those strategy, the daily strategy. So after that, you may start to make your money in the options market. So today we'll be talking about the vertical spread. And once again, in the weekly classes, we are not going to upsell you any courses, and then so far all the recording are free, but we might set up some threshold for you to get access to in the near future. And then we are not going to sell you any classes, including today, and we are not going to collect any of your personal information or any of your money. If someone come to approach you using my own personal name or the company name, then it might not be us. So please be So let's start on today's section, and hopefully we can step by step get into from a very beginner to a financial expert in the market, and hopefully to make some money together. So for all those people that are new joiners, I will just give a little bit of introduction of my own to you all first. My name is Hu Yun Lo, and you can call me Jay, because we used to call the first letter in here. So my first letter for my last name will be Yun Lo, JL. So they used to call me Jay instead. So you can call me Jay, and then I have 4 years of experience in fund management, 2 years specialized in quant trading. Quant trading which means that I used to build my own algo trading board, and then I use it to manage the other funds. And my personal annual return might be around 26 to 33%. It might not be huge when comparing to all those peers in the market, but I would say that my way will be more stable and steady when comparing to all those roller coasters, right? So it depends, because my risk appetite is more adverse when comparing to the others. So yeah, I'm satisfied with it, and then here I'm become a new trainer for uSMART. Okay, so let's move into today's classes. In today's classes, we will talk about the bull vertical spread, and then we will dive into the 2 of the most powerful vertical spread strategy for the bullish market. 2 strategies we discussed for today. The first one is the bull call spread, and then the second one is the bull put spread. So you can also make use of the put, not only just the call. And both of them have different pros and cons, but they are all aiming to profit from the upward momentum in the market. So the first criteria to use all these strategies for today is you need to apply it in a upward movement stock or market. And then whenever you are an expert trader looking to refine your strategy, or you're just starting with options, today's sessions will provide you a very actionable insight and a practical trading knowledge. So make sure you stay tuned, and then we will just going to move into these 2 strategies today. So before we get started, let's look at what we will cover for today. So our journey is structured into 4 main segments. We will start with the essential fundamentals to ensure that everyone has a solid foundations, and then after that we will dive into the bull call spread for about 15 minutes, and then followed by a bull put spread for another 15 minutes. Then we will conclude it with another live trading application for about another 15 minutes or so. So the whole section might be around an hour. And by the end of the sections, you will have to master all three key aspects. The first one will be you will know how to construct all these spreads profitably, and then you will also learn how to manage your risk efficiently. And then the aim, you are going to able to execute your trade with confidence. So let's start on today's session. So I'm sure that every one of you already know the fundamentals of how the options work. So the options, we only have 2 options. One is the call option, and the other is the put option. Whereby the call options is actually targeting an upward movement. So you are actually expecting the price to break a certain level at the near future. And then the other aim, the put options is actually expecting the price to drop and break a certain support. So I will just say that one is targeting to in the future to buy at a very low price, and the other is expecting in the future they are able to sell at a higher price compared to the market running rate. So that is the difference. And so now we already know the basic fundamental. If you are not clear with the basic theory, you might look back on the recording, and you can just search it on the Hong Kong apps, and then else you can just contact me at the end of the sessions. Then I will just share you the list of the video recorded, and then you can just referring to the first lessons and the second lessons to have a better understanding on how the options work. Whereby the first lessons we cover the buyer side, and then the second sections we cover the seller side. Okay, so now we already have the basic fundamental, a very strong fundamental. We'll just move into the vertical spread. So I will talk about the secret to a successful options trading is not about being right, it's about being right efficiently. So there are two it can tell the difference. Being right means that you are making some money, but if you are able to take a step more advanced, you are able to make it more efficiently, then it will be another different story, whereby you can utilize your capital in a more efficient way, so that you're able to just to produce and more return, and when comparing to the current when comparing to your current performance. So let's dive into it. So the first one is you need to understand why vertical spread is such a powerful tool in our trading arsenal. So what makes them very special? I will say that the first one is they offer a defined risk parameter, as same as a single leg options, whereby in this case we talk about call options only because we want to make it simple, so we won't talk about put options. So in today's cases we only talk about the call options. So in the call options, if you are making a single leg trading, you are able to just limit your risk at the premium pay. So you will not lose anything more than the initial premium pay. The initial premium pay is the maximum risk at your hand in this particular options trading. So in actually a vertical spread is also similar, but the difference is it just make another short position to get some premium in the market to cover a portion from your cost. So the basic fundamental is still same. They are looking at the same bias in this case, which is bullish. So you can see that the risk is also limited at the initial premium pay. It's just that they can reduce the initial premium pay by shorting another position. So same as single leg option, the vertical spread also have a defined risk parameter. And then the second point is lower capital requirement. I will say that it requires less capital than outright stock positions. So the stock requires the most position, whereby the single leg will require a lesser capital when comparing to owning a stock, because one option is equal to 100 shares, so that there is a leverage force inside that. So you're able to enjoy the profit from 100 shares, but use a lesser cost. And then here comes the third one. The vertical spread have a lesser capital required when comparing to a single leg option. Why is that so? Because we are making the premium from a shorting position to cover a part of the cost. So the order comes into this. Stock require the most capital, and then the single leg options require lesser when comparing to stock, and then the vertical spread require the minimum costs among all those three. Okay, third, the flexibility in the market condition. So the vertical spread gives us a very flexibility in different market conditions. You can either go long, you can either go bullish or bearish, and which we will cover the bearish strategy in next Wednesday. And you can be in debits, or you can also want to be in credit, also can. It's all up to you. So that in today's section we will talk about two bullish strategies, and the first one will be in the debit situation, and the second will be in the credit situation. So it's all up to you, and there's pros and cons, and we're going to review later on. And the fourth, which is the last one, the last pro, why we are using the vertical spread, because it enhances the probability of success. I will say that when comparing to a single leg options, although it will just limit the potential profit, but it will make you more easier to be in profit, as it reduces the cost for you to get into the position. So the movement that require the stock to move will also reduce. It's also lesser. So being profit is way more easier when comparing to having a single leg option. And this is also mentioned, being profit is more important than profit how much. Profit how much is not really important, but the first thing we need to ensure is being profit first. So remember this key principle. We want to being right, but also efficiency. That's why we are doing a vertical spread. Okay, so we will go into the structures overview for a bull call spread basics. Let's start with the bull call spread. They call this strategy involves two simple steps. The first one is we buy one call options at a lower strike price, and then we sell another call options at a higher strike price, and both with the same expiration date. Let's look at one concrete example. Imagine the stock Tesla is trading at $100. So we will buy the $100 strike price for a $5 premium, and then simultaneously we will just sell another strike price call options with strike price of 105. So there's a $5 difference in the strike price, and then the selling positions will make us a $2 premium. So initially we pay for a $5 premium, and now we collect back $2 premium, and our net cost, our debit will be $3, because we pay for $5 for the buyer position, and then we get into the seller position to earn back $2. So the net cost is $3. So this structure actually gives us a very bullish position with a defined risk and reward, because the first thing is when we are doing so, you can already know that the risk that we in that case is $300, because you need to pay $3 premium for every share. So at the net, the maximum losses you can make is $300. And then the reward is also limited due to the shorting position, because when you short the position, the most that you can get is actually you can actually just benefit from the range in between, and the other upward movement will be offsetting together with the shorting position. And we'll move into the detail bit by bit. And now we'll just talk about the risk to reward ratio profile, so it can be better for you to understand your age or understand your position. So the max profit will be the strike price difference minus the net debit minus the cost that you pay, and then the max losses only limited to the net debit paid, and you have a break even of the lower strike price plus the net debit. It might be, I don't suggest you to just memorize the formula, so I will just move into one of the example that we are giving every day, and this is the strategy that I suggested yesterday, and we will just move into it, and then we will just understand it from the basic theory, and then we don't need to memorize the formula. Understand the theory, the underlying theory is more important than just memorizing the formula. So let's look at this example, which I suggested this strategy on 2 days ago, I believe. So the first one is, this one is actually constructing a bull call spread strategy. So the first move is you buy off call options with a strike price of 60, and then pay a premium of $3.40, and then you sell another call option with a strike price of 64. Now you can see there's a $4 difference in the strike price, and then you are receiving a premium of $1.26 for this selling position. So the first thing is you calculate the net cost that you pay for this option strategy. So you can just using the premium received $1.26 minus the premium paid $3.40, and then you will get a $2.14 net cost per share. So that will become your net the maximum losses that you'll be able to encounter for. So you can see that at the below profit and loss analysis, the maximum losses will also become $214 because the premium you pay for this strategy is $2.14. So the options equal to 100 shares. So there's so the maximum losses you can entitle for this 100 share will be 214, which is this 214 is the initial premium that you pay for this strategy, and also the maximum losses you will be entitled for. And then now you already know that you are going to pay $2.14. That will be your cost for this option strategy. So what you do is you calculate the break-even point. Since you are actually targeting an upward movement, so you only look at the buyer positions, exactly the same as the single leg calculations. So the single leg calculations is just that the strike price add on the costs. So exactly the same as the single leg options, we also using the buyer position strike price add on the costs. So in this case, your cost is $2.14, and then you have a strike price of 60 for the buyer position. So your break-even point will be 60 plus $2.14. That will make your break-even become $62.14. And now you already know that your break-even is $62.14. And then wherever they go above $64 is offsetting each other. So you only entitled for the room to benefit from the room in between your break-even point to the upper strike price, which is 64. So whatever price that fall in between $62.14 to $64 will be in your profit zone. And now you're able to calculate your maximum loss profit just using 64 minus the break-even point, and then you multiply it by 100. You will get a maximum profit of $186. As simple as that. So you understand how this all flow works. First one, you calculate the net cost for this strategy, and then you just multiply it by 100 to get your maximum losses. Then afterwards, just exactly the same as the single leg options, you calculate the break-even point just using the lower strike price add on the net cost that you pay. Afterwards, you know that you benefit from the break-even until the upper strike, and that will be your profit zone, and then you're able to calculate the maximum profit. As simple as that. Personally, I don't memorize any of those formulas. I just use my basic understanding and then to structure all of those together. So now we will move into the grid analysis. Let's talk about the grid. Grid is very important, yeah, because this is the risk measurement tools that we use for options, and we have talked about it in the lessons 4, which we go through all the grids and why all those grids apply a leverage effect on the stock, and also how to choose among all those grids to choose the most suitable options from it, just using the grids. So the first grid that we want to talk about is delta. We want the positions with a delta between 0.4 to 0.6, because we already say that a delta is actually equal to the winning rate of these particular options to be in the market at the expiration. which in simple human language is it equal to the winning rate of these options at the expiration date. Winning rate at the expiration, as simple as that. So the greater the delta, which means that your position have a better advantage when comparing to the other options because your winning rate is higher. So in this case, we are choosing 0.4 to 0.6 is because it gives us a 40 to 60% winning rate at least. And it will also give us enough directional exposure without excessive risk. Because when the delta is in the money, the normal delta will fall into 0.5. So if you are choosing one below and then you're selling another above, it will be around 0.4 to 0.6, as simple as that. It also gives you a higher probability that these options can be in the profit as soon as possible. And the second is the data. The data actually accelerated near the expiration. Data also referring to the time decay, so which is typically negative, but is less severe than a long call position because we are selling at a higher strike price. So this helps to offset some time decay, but I personally will advise you to just quit the positions 1 month before the expiration, because at the last month, the time decay actually accelerated at a very fast pace. So you might lose some of the money due to the loss of time value. The last one is Vega. The Vega will be limited to the volatility exposure. Why I say the Vega exposure is limited is because you are actually having opposite Vega effect in the vertical spread, because you are having a long options and you are having a short options too. So each of those positions, you're actually having a opposite Vega effect. The long option in the spread gains value when the implied volatility increases because of the Vega. When implied volatility increases, Vega will make the premium become more expensive. So the short position in the spread, the highest spread price selling positions, actually will lose the value when implied volatility increase. So these opposite Vega effect offset each other to some extent, so that it makes the overall strategy less sensitive to volatility changes. But this combination will make you benefit in a higher implied volatility environment, because you also can profit a lot from the selling position, which by you selling a position in a higher IV market, you're able to collect more premium from higher implied volatility. So it can reduce the net cost and just mitigate some of the risks associated with a drop in the IV. Okay, so at the end, you can just see that this opposite position actually reduce the dependency of your options on volatility. So how are you benefit from this opposing effect? It actually can make you just focus on only the direction movement. As simple as that. So now you don't need to worry about Vega, and you don't need to worry are you selling or buying it at a higher price when you compare to the market rate. Even though you are buying higher rate, you're also selling at a higher rate. So you actually just can just focus on the direction instead of the implied volatility. Now we will talk about the entry criteria for bull call spread. Let's take a break. As we all know, timing is actually very crucial for us, the trader, to be successful. So here is some idea setup checklist for myself to just make a bull call spread. So first of all, we want a very clear bullish technical signal. Look for the stock trading above the 20 EMA or anything above, you can just look for your technical setup. If you are using just a naked chart, then you check if the current market structure break or not. If this is still in a higher low situation, which means it's an upward movement, so that will be a very clear bullish technical signal. Second, you need to identify, is there any support level nearby? This is my personal habit, where I need to spot a support level nearby before I get in. So I have something which is I call safety net to just increase the probability that it goes up. So the third one, reasonable implied volatility. Even though we say that the opposite Vega effects will just cancel off the implied volatility effect, but we also prefer a moderate level, because the higher the implied volatility, the net costs also increase. The higher the volatility, the higher the risk. And the fourth, you need to have a very clear catalyst identified. So it could drive the stock higher. Either it will be earnings or any news nearby, or even though some analyst report also can. Just some catalyst that can drive the stock to go higher. Always confirm and last thing is, I always confirm that the options volume exceeded the open interest. So this will ensure I have enough liquidity for me to get in and get out for my whole vertical. Because you want to avoid a situation whereby you get into the buy position and you don't have enough liquidity to get into the sell position. And in that case, you are actually not making a vertical, but you are going for a single leg options. And you need to be aware of that. And if that is the case, whereby you need to make it one by one, I would recommend you to just go with the direction first. Go with the buy position first, because the short position, what is the short position serve for? It actually serving to reduce your cost. So your main purpose is you need to benefit from the trend. So the buyer position, it need to have a higher priority when comparing to the selling position. And this will be my entry criteria for me to build a vertical spread. And after we get into the position, we need to have an exit strategy too. And having a very clear exit strategy is just as important as the entry. And usually I will just plan my exit before I get into any position, because as I say, people tend to have the most reasonable mind before they get into any position. The analysis that they make is always the most accurate versions that they will be able to generate, just because they don't involve anything personal information or personal bias when they are doing a pre-entry analysis. So make sure you do a very complete analysis before you get into any position, and you state up what is the exit criteria for you to get away from that position. You need to predefine your exit strategy before you get into any position. The first one is you might target some certain percentage of the maximum profit, because waiting for a 100% maximum profit is often doesn't worth the additional time and risk. So as I always say, being profit is more important than profit how much. So make sure that we be in profit first. We don't need to take 100% profit. Just some certain percent that can make you satisfied, you do. And then you can actually see all those three are actually just the three components for the profit target and also the stop loss. The first one is certain percentage of the profit or the losses exposure. So let's say that you need to consider just exit the position if you lose 25% of your maximum risk, I would say. So this will preserve your capital for another opportunity. So the risk percentage and also the loss, the profit percentage is all up to your personal reference, and you may decide it by yourself. And you can see that if the stock have a technical support breach or just some support and resistance breakout or retest, then you can consider to make your task to quit your position. Let's say you are looking for a very bullish setup, and then you get into a position. Once it reach the resistance, you may consider to sell it because you're expecting the resistance to play effect, and then you will just make the price to retrace. Or you actually trying to get into a support where you already get into a position, and that support break, it doesn't hold at that level. You may also consider to quit your position. So it all depends on your technical analysis. And the third one is you might need to consider you want to exit your positions with the time basis or not. I always have a time basis exit because just like I want to just minimize the time decay effect on my strategy. So if the time decay just reduce my strategy value to a certain level, I will quit it even though the price doesn't achieve my take profit level. Or I might consider to quit before certain dates before the expiration because I don't want to experience the accelerated time decay. So this will be three of my aspects. The first one is percentage based on the P&L, and then the second is the technical analysis on the chart, support and resistance. The third one is the time-based exit. Either you can consider a time decay, or you can consider avoiding the accelerated time decays. So just the time basis exit. So now we already done talking about a bull call spread. Now we'll move into another position which we call the bull put spread to encounter for this bullish market. You can see that in the last case we talk about only call options, which we buy the call options and we sell the call options. So now we're only using the put options, but you might be worried about why we are using a put option instead, because put option is actually targeting a downward movement, but we can actually play with it and then make it to target for a bullish market. So everyone, just bear with me and let's have I would say a 1 minute break before we get into this. After this strategy, we will just go into some real-time, some real trading examples, and then we will just close for today's lesson. And just to mention, on every Wednesday, we have an advanced options trading lesson, and on every Friday, we will just talk about some psychologically manners in trading and investing, and maybe I will share some personal insights on the psychology part and also my own experience and story throughout all this journey, and that will be on every Friday. So after you listen to all those psychologically advice, story, and then you can rest well for the weekend. I believe it will be more suitable to arrange it in this way, and hopefully we can stay all together. So now let's transition to the bull put spread, where while this strategy is also bullish, the mechanic will be different from the bull call spread. Yeah, we are using put instead of call, and here we will just sell a put. We'll move into the mechanic later on. So you can just aiming for a bullish bias but doing it in a very different way. And at the end, we will comparing how these two strategies differ, and then how what is the pros and cons to select from all these from either of these strategies. even though they are both targeting the bullish market, you can select the most suitable strategy by yourself. So actually here, the key element to form a bull put spread is actually we sell a higher strike put and then we buy a lower strike put. You can tell the difference. The call spread, we buy first and then we sell. In this case, we sell first and then we buy. And then we collect a net credit. This is also the advantage when comparing to the call spread, because you get paid immediately to enter into the position. And this credit is also represent your maximum potential profits. And this strategy can be profitable even if the stock moves sideways without moving upward. So it will be perfect for a bullish to a neutral outlook. So when comparing the first one, you only profit from a bullish outlook. And in this one, even though it doesn't move outward, it stays neutral, you also will be profit. And this is the most key difference. The first one, you pay first, and then you make profit from it moving up. And this one, you get paid immediately. You collect the money first, and then you have a higher winning rate, because even though it doesn't go up, you stay neutral, you also will get profit. But you need to understand the margin requirement is very crucial for a bull put spread. And the maximum risk is the difference between the strike price, the white between the strike price minus the credit received. So for example, with a $5 strike white and then you have a $2 credit received, your maximum losses will be $300 per contract. And you need to ensure that you can maintain your margins level, so you don't need to get into any liquidation situation. So in this case, I would say that the volatility actually play a very crucial role in the bull put spread. Unlike the bull call spread, this strategy often performs better in higher implied volatility environment. Why? Because higher volatility means that higher premium, higher option premium, and as a seller, you want to collect more premium. You need to pay attention to the difference. For the call spread, we are actually having a buyer position. We sell just to reduce the cost. And in this one, our main focus is the seller position, and we buy to just limit the risk. So you need to tell the difference in between. First one, we are the buyer positions. In this one, we are the seller position. So as a seller, you want to make the premium, and which is why we are aiming for a very high implied volatility in this case. Because higher IB means that higher premium. And the second, you need to pay attention to the volatility skew. So when the put options are more expensive than the call, it can make the bull put spread even more attractive. And you need to check the IB rank. The reading above 50% often represent a very good selling opportunity. And we already talked about it in the lessons 2, the benefit, the beauty of being a seller party when you're comparing to a buyer party. You have a higher winning rate, and of course you make lesser. Lower risk, lower return, but the key is stability. And high winning rate make your mentor more even comfortable when you're comparing to a buyer position. And you need to make sure that you have an active management, because active management is actually the key to a long-term success. When a position moves against you, you have several adjustment options. The first one is you roll down for additional credit. I will explain what it means. Actually, is just to close the current bull put spread by buying back the existing contract. Just you close the current vertical spread, and then you open a new one at a lower strike price. So in this case, you can collect additional premium to offset the losses previously, and then you make the break-even point even lower. But you need to be aware of the risk also, because you open another position, so you are actually also taking a new risk, but at a lower strike price, and it could lead to losses if the stock keep falling. And people also have a strategy which is called rolling, and then they keep on rolling and rolling to just avoid from being in losses. But you need to be aware of the falling knife, yeah. So this strategy is actually very powerful strategy. Rolling strategy is actually very powerful for us to make from those stable movement stock. The second, roll out in time. What does it mean? It's actually meaning that we extend the expiration date of the position by closing the current spread and opening a same strike further out in time, which means that you close up your current position, and then you open another with the same strike price but a further expiration date. Why we're doing so? Because it provides you more time for the stock to recover. If you are in loss, and then you need more time to just recover back from your losses, and this will help you. And it also allow you to collect more premium due to the time value of options, because the longer the expiration date, the higher the time value. So the first one is you keep moving down. You close and you move for the lower strike price, but the same expiration date. And the second, the strike price remain the same, but you are rolling it further up in time. It's a vertical and horizontal, diagram analysis. And then the third one is you convert it into an iron condor, because iron condor actually having a higher risk to reward ratio. So when you already can tell that the market is not moving up and you're going to stay neutral, then you can just convert it into an iron condor. And why we are doing so is because if you lose, the another positions for the iron condor can provide can just cover part of the losses. And then the fourth, you can just add a stop position. So you can just adjust your directional exposure to become more bullish. It's same like a discounted DCA, which means you're buying when going lower. So if the stock get to rebound, get to recover, your positions can just offset the losses from the bull put spread. So actually, when it falls, you just buy more. So once it bounces, it will be more easier to use to just recover from the losses. The break-even point get to drag down a little bit lower when comparing to the initial position. And this will be the warning sign for your positions, and you need to be aware of it. The first warning sign is the delta. And if the delta is accelerating, because the delta is actually measuring the price, the sensitivity of the options to the stock price. So if it gets closer to your strike price, the delta actually increasing. So you will have a signal of high risk. So if it's exceeding certain level, you might need to consider to close it down, because you are actually a seller position. So you want the delta to be as low as possible, because once again, delta represents the winning rate of the buyer position. So as the opposite position, you need to ensure that the delta at the minimum. So you as the seller have a higher winning rate. And the second is the support level break, because we already said that this strategy is actually targeting for a bullish or neutral outlook. So if some certain support level is break, then it means that there might be a reversal in trend or market switch of structures. So if certain technical very important support level is break, you might need to consider to adjust your position. And the third one is the implied volatility spike. And if volatility increase, it means that higher risk. And the last one is the earning or event risk, because it's also related to the third point, whereby the earning and event will increase the volatility and hence increase the risk of your position. Now we already covered both of those strategies, and we'll move into how to make the live trading application work. So we're done with the theory and we are going to move into the practical. And also a 1 minute break will be given for you all to just take a rest, and then we will move into it later on. This will be the last section, and then after all we will just end for today's lesson. And after today's lessons, you might be able to understand how all these vertical spread work, and then you're able to just execute your trade based on our advice, and hopefully you can make some money out of it. Then it might be your first step to step into the options market. There will be the daily strategy sharing on the WeCom group, and you can join the group by contacting us. Now look at this case study. So yeah, in this case, I'm taking the Apple as a case study, and you can see that it's in an uptrend rally. So it fulfill our first criteria of an uptrend setup. And I just do a very simple analysis from the chart, where I look at the capital allocated around across this year, and then I can see that there's actually a very strong capital allocated nearby the price, and you can see that the most capital is actually allocating around 223 to 225, and that is the range that provides the strongest support to this chart. And you might consider to get into this position because I already spot a very strong support nearby, and if this support is break, which means that there are many people is losing money because this is the most capital allocated, and if this support is break, you might consider to manage your position. Now the first ideal condition is bullish. We already identified that this is a bullish stock, and I have a very nearby support level as a safety net for me to manage and for me to just benefit from these buyers. Now we will just construct our strategy. So you can hereby I take a screenshot of the Apple option with 32 days until expiration, and you can see that for now the current strike price is actually allocated around 230, so 230 latest price, and we want to go into two of these cases, the bull call spread and also the bull put spread. Let's go into the bull call spread first. So in this setup, you can actually see that the current Apple is actually trading at 230, and we buy one with a lower strike price, 225, and the premium that we pay is $8.90. So we are going to pay $8.90 for this buyer position, and we are going to have another seller position at a higher strike price of 230 to cover the premium pay in upfront. So the premium that we receive from this selling position is $5.69. So the net cost that we need to pay for this strategy will be $3.21. And it greatly reduced the initial costs. We can compare it with a single leg. If you are doing the single leg, you need to pay $890 for this direction bias. But if you are going to do a vertical, you only need to pay $321, and you save around 500 something. So you can just make use of those 500 something to get into another position for another stock. So this is the benefit of the vertical when comparing the single leg. You can get your exposure more to another stock, reduce the costs, and increase the exposure, more efficient in managing your capital. And please be aware of how all these strategy to be executed in the uSMART app. I'll just illustrate a little bit. Whereby there are many people asking, oh yeah, it cannot be shown. Never mind. Maybe later on we will have another sharing section, and we will just share about how to actually execute all this. When you click into A, and at the bottom right corner, you will see a trade button. And once you click it, then you can see three options. The first one is buy/sell, and the second is short selling, and the third is the smart order. And you can just focus at the first one. And for the first, the buy/selling is actually for a buyer position. So in this case, you want to buy a call options. You click on the buy/sell, and then you can just place your buy order there. And then you want to go to the another options, which is you want to sell the call options. And then you can select the short selling tab, and then you go for the selling position. Don't go to the buy/sell tab for the seller position, yeah? Because the sell in the buy/sell tab is actually referring to closing the buyer position, but it's not referring to opening a seller position. Okay, so this is the bull call spread, and then now we'll look into a bull put spread. So still the same setup, and then in this case you are doing a bull put spread, whereby you are actually targeting on the seller position. So we sell at a higher strike price, 220, put at $1.69, and then we buy another lower strike price, 215, put at $1.01. And then you can see that the net credit that we get from this strategy is actually 65 cents per share. So that once you already completed this vertical spread, and then you would make the $65 immediately. And whenever the price moves above 220, you will be able to make money. So in this case, you can see that the support that we have is actually around 223 to 225. So in this case, we are selecting 220. It's actually already below the support zone, below the capital allocation. So once you already get into this position, you have a support above your selling position, the seller position, to protect your buyers. So this is how we do a bull call spread and also a bull put spread. And we will talk about a little bit of common pitfall to just make us able to survive longer in the market. So let's learn from the common mistake. The biggest one, position sizing. Never reach more than 5% of your positions on a single trade. And then the second one is ignoring the time decay. Even though even though sometimes the stock moves into your direction, but you also lose due to the time decay. You need to measure the balance in between the movement and also the time decay. And the third one is, if you are going to select a very poor strike, like you are targeting a very far target, then it might not be ideal for you, because I will say that out the money option is good because it's cheap, but it also have a lower winning rate. So you need to take the balance in between the winning rate and also the premium paid. The last one is you don't have any exit plan. This is also the most significant mistake among all of them, because once you already get in, I will always suggest you to plan your exit before you get into any position, because you are at your most reasonable mind before you get into any position. So this will be my suggestions. The best practice to avoid all those mistakes. The first one is keep the size lower than 5%. Keep the size smaller, then you're able to make a more reasonable decision. And the second, define all the exit before the entry. Don't let your emotions to get interrupt into your decisions. And the third one, you can monitor the grids daily, because the grids actually represent your winning rate, and you need to be aware of the risks. And last one, document all the trades. It not only just apply on the option trading, but it also apply on all the financial instruments. If you are a trader and you are an investor, make sure to document and journal all the trades so that you can know in deep down what contribute to your profit and what contribute to losses. You need to erase all those factors that stopping you from profit, and then you only take those trades that stand on your side and support and contribute to your profits. Now we will come into the key takeaway. Let's recap on the key learning today. So a bull call spread actually works the best when you have a very strong bullish and volatility is low. So you can tell the difference. A bull call spread is actually a debit spread because you are actually paying to bet on the directions, whereby the bull put spread you are collecting upfront, a credit spread. And the second is, if you are going to a bull call spread, a call spread, then you need to ensure you have a higher delta position. So the winning rate is also higher. And for the bull put spread, why I say that it have a higher probability of winning, because your outlook is also wider than the call spread. The call spread you're only winning from a bullish market, but in the bull spread you are actually benefiting from either it moving up or it moving neutral sideways. You also make money. So for a bull call spread, you work the best in the low implied volatility. Even though the Vega effects will be offsetting each other for the opposing Vega effect, but lower implied volatility means cheaper. You're able to use a lesser cost to just get into this strategy. Whereby the bull put spread work the best in a high implied volatility situation, because you are actually a seller position. So the higher the IV, the higher the premium that you are going to receive. That's it for today. We already covered the two vertical spreads to be used in a bullish market, and then this will be my personal recom for you to contact with. If you have any questions, feel free to contact me, and then feel free to raise any question. And if you have a very desired topic to discuss with, also feel free to contact me, and then we will arrange it in the near future. Not only about options, you can talk about anything in the financial market, and we can solve it together. At last, I will also share about the benefit of opening a uSMART account right now. If you are going to open a uSMART account right now, you are going to receive a Tesla share, a 0.02 Tesla share, and the more you deposit, the more cash voucher you are able to get. And then if you are interested in going to start your trading journal, feel free to use all these QR to register. And the upper one will be the Singapore QR, which is the global app. And if you are located in Hong Kong, then you can use the below QR. And at last, I will just sharing the disclaimer before we end for today's section. Thank you all for joining, and then we shall see you on the next classes. If you are very interested on the psychology of trading investing, feel free to join on the Friday course. And if you are more interested on the technical advanced strategy in options, feel free to join the next Wednesday course. Thank you all for joining, and then we will end our sessions for today. Hope to see you guys on next lesson. Thank you.